Because there's a lack of clarity on certain things. Our next guest, David Kudla, is ready to give us his opinion, CEO, Chief Investment Strategist, Mainstay Capital Management. So the question here is, I saw something from Ed Yardeni that said, don't be so quick to write off 2025. But right now, an investor will look up and say, oh my goodness, we're down 1,200 points. Again, they can't take it anymore.
Well, and Nicole, good afternoon. I think it depends on how you're investing in 2025. And I think Ed Yardeni, he's looking for a better second half of the year. But if we're talking about right now, today, this week, this month, how do investors need to be investing? And, really what it's been about is to be away from U.S. stocks. We're at peak uncertainty right now for the U.S. stock market and very poor sentiment. So that brings us to, if we look over the past couple of years, you could buy an S&P 500 index fund and do very well. A buy and hold portfolio did very well. A portfolio diversified with periodic rebalancing where you bring it back to that same level of stocks, bonds, or cash that you started the quarter with. Those are all fine in a continually rising market. But now, that's level 1, level 2, and level 3 investing, we call it. Now what you need is level 4 investing, and that's tactical asset allocation. And that takes us to places like Europe. We compare Europe to the US right now. Their monetary policy, they're easing, we're on hold. Their fiscal policy, Germany has a spending package, the EU has a defense spending package. We have fiscal austerity here with what's being done through Doge and cutting back on government spending. So, and better relative valuations. We like Europe a lot. We've been there for a while. Also, liquid alternative investments. And I'm not talking about illiquid alternatives, but these are, you can buy through an open-end fund or ETF or ETN. They're available on the Schwab platform, all platforms that have daily liquidity, but you take advantage of hedging strategies, long-short strategies to do well in a portfolio, to actually do well in an environment like this. Components of your portfolio like gold that have a positive return while you're watching today and U.S. stocks are down and bonds are down.
And you said you're watching gold. That might be somewhat of a safe haven because the talks with, or no talks, the situation with China is becoming more serious, and that concerns you, right?
Yeah, it does. And it's become the ultimate safe haven in this market because concern about the dollar, concern about what these policies mean for the U.S. dollar. We've seen the U.S. dollar come 10% off its highs last year, and that's problematic. And what's interesting is the dollar is declining as bonds are declining, which is not the typical reaction function, but that makes international investments more attractive because the currency exchange rate, if you're unhedged, and gold is just with central bank buying, some of the dynamics there has been a very attractive asset class tactically for us to allocate in our portfolios, and obviously it's been a tremendous hedge.
And so at this point now, tell me more about what you think when you look at the debt and what the whole big plan is. Because folks are thinking that the president is trying to lower rates, lower the rate environment so we can pay down the country's debt, which needs to be refinanced. In the meantime, they're seeing all these stocks down 20% or more. 2/3 of the S&P 500 is down 20% or more. Are there going to be some great opportunities here? And is the big plan working, or maybe can it work? Is that the question?
Yeah, I mean, and if that's the plan that Scott Bessent and President Trump had thought through, that worked until early April, and we actually saw bond yields coming down. They came down from a high around 4.7, a little over 4.7% on the 10-year, down below 4%. I think when they got worried, and when we all got worried, is when bond yields started moving back up. And so we had the stock market going down, bond yields were no longer going down, but we're coming back up. And that's, again, part of that concern about the U.S. economy, what's going to happen with tariffs, what's it going to do to inflation, what's it going to do to recession. I mean, our base case for 2025 is what we call stagflation light. Okay, it won't be as bad as the 1970s, but we have all the ingredients. for what we define as stagflation. In that environment, there's some places we really need to avoid, but it does create some opportunities like in gold, which is an uncertainty trade and an inflation trade.
Right, understood. So what do you think else are you watching? The labor picture, how much you're worried about inflation, but the labor part of it has become part of the rhetoric. Last Thursday, we heard Jay Powell talking about exactly that, concerns about unemployment possibly rising.
Yeah, that's the concern for the Fed, really. And we knew this was coming. They would be between a rock and a hard place. The economy would start to slow. And I would submit this isn't an exogenous event or part of the normal cycle. This has been self-imposed, whether you believe in what the tariffs policy is to accomplish long-term or not. It could create a recessionary environment in the U.S. At least we are seeing a slowing of the economy. We're seeing earnings taper off from expectations. And if we do, move to a recessionary environment, certainly labor comes down. So, it's a question is which way does the Fed lean on its dual mandate? And I think with Powell, it's pretty clear. He doesn't want to cut. I think he's leery about cutting rates, or FOMC, about cutting rates into a still inflationary environment. But the keeping rates where they are is probably the path here for a while. I know there are forecasts for as much as 5 Fed rate cuts this year. And for as little as 1, we'd be closer to the 1 or none. That's been our base case. We just think it's going to be tough in this environment for them to follow through with multiple rate hikes if it's the second half of or rate cuts if it's the second half of the year.
Look, I mean, one cut is not going to make a lot of people happy, namely President Donald Trump. You have folks pricing in 4 cuts this year, and we just showed the heat map, and all the Mag 7 are down. People want something, glorious and optimistic to hold on to for 2025. What's the takeaway, David? What do you tell them so that they don't feel terrible?
Yeah, so first of all, again, when we look abroad, specifically Europe, and I laid out the thesis for Europe, why it's attractive in this environment, and because of trade policy, more countries looking to trade with Europe because of what's going on with tariffs here in the U.S. So Europe and the broader international foreign stocks, we're at 3 times the allocation we were last year in many of our portfolios for overseas exposure. Gold, we think, continues to perform because until something changes, and that something is we've got this standoff between China and the U.S. It's we're really at peak uncertainty, and in that regard, there's been a lot of negativity priced in, but there's some value-oriented stocks that are still doing well. Consumer staples we like because consumer staples tend to do well in a recessionary environment. So there are areas where investors can look forward to a positive return if we stay with the type of environment we're in now. But there is hopefully some hope on the horizon that the tariff policy, some deals get done. They haven't yet, which is a little bit concerning. 11 days into this 90-day a moratorium or a 90-day delay on the tariffs, we'd like to see some deals get done with countries and really get some relief and some confidence that we're going to get out of this stalemate, this standoff with China and some of these other countries.
Okay. David, great to chat with you. Let's talk again soon and sort of regroup on this. I mean, if you're closer to the 1 cut rather than the 4 or 5 cuts, I mean, it sounds like you certainly have some optimism on investing abroad, maybe some certain sectors that might be more, a little more recession-proof, let's say, a little safe haven. Great to chat with you, David. David Kudla, CEO, Chief Investment Officer, Mainstay Capital Management. Thank you.